Welcome to The Explainer. Today, we are taking a deep dive into the mind, the methods, and honestly, the absolute madness of one of Wall Street's most legendary and definitely most misunderstood figures. We're talking about Michael Burry. You know, this is a guy who doesn't just read the fine print, he practically interrogates it.
And if you're wondering why we should even be paying attention to him, well, just take a look at his track record. A massive 489% net return between November 2000 and 2008. To put that into perspective, the S&P 500 returned, about 2.4% over that exact same period? It's wild. He was pulling off this astronomical growth right through the dot-com bust and directly into the teeth of the worst financial disaster since the Great Depression.
So, the big question we're answering today is this. How exactly did a self-taught, former neurology resident manage to outsmart the absolute brightest minds on Wall Street and walk away with a windfall of roughly $800 million for his fund? It's just an incredible narrative arc. And to really understand his recent highly controversial market moves, we have to start with the trade that made him an absolute legend.
Section 1. The legendary Big Short. Betting on a housing crash.
Okay, let's dive into this. The 2008 crisis was, for most people, defined by pure financial despair. Markets crashing, massive institutions literally crumbling. But back in 2005, while everyone else was blissfully riding the housing bubble, Burry was sitting alone in his office, reading hundreds of pages of dense mortgage bond prospectuses. And he discovered that the loans underneath these bonds, particularly the adjustable rate mortgages, were incredibly weak. They had these teaser rates that were set to reset way higher after 24 months. He realized that even if home prices just stopped rising, defaults were going to completely surge. He was perfectly comfortable betting against the grain, anticipating peak stress in late 2007.
Section 2. Decoding credit default swaps.
And this brilliantly illustrates the foundation of the whole system, mortgage-backed securities, or MBS. We all know how mortgages are pooled together by the thousands, right? But the fatal flaw was really in step 3, the tranches. Banks were taking these massive pools of loans and splitting them up by risk. Burry knew those lower tranches were entirely toxic. He just needed a way to short them.
Now, since he couldn't just traditionally short these incredibly complex bonds, he had to go to the big banks and essentially ask them to create a customized derivative just for him. Enter the credit default swap, or CDS. Think of it like fire insurance. With traditional insurance, you actually have to own the house to buy a policy on it. If it burns down, you get paid, right? But a credit default swap allows you to buy fire insurance on someone else's house. You can literally insure Terrible Corp's burning house without owning the property. So Burry paid regular premiums to the banks, just waiting for the housing market to catch fire. As long as people paid their mortgages, yeah, he lost money on the premiums. But when those defaults finally hit, the payout was astronomical.
Section 3. The contrarian value philosophy. Burry's philosophy.
So what drives him? At his core, Burry is a classic deep value investor. He's heavily influenced by Benjamin Graham. He screens thousands of investments looking for a strict margin of safety. His goal isn't to chase momentum or buy whatever stock is trending. His goal is to find assets trading at a massive discount to their true intrinsic value. Doing this mathematically limits his downside risk, and it provides a buffer against his own errors or sudden market volatility. Basically, avoid permanent capital loss first and let the upside take care of itself. As Burry himself puts it, minimizing downside risk is key, distinguishing between gained dollars and lost dollars. And he holds on to this principle with an absolute iron grip, even when it makes him deeply, deeply unpopular. Get this, during the Big Short trade in 2006, the premiums he was paying caused his fund to temporarily drop over 18%. His investors absolutely revolted. I'm talking hostile letters, threats of legal action, demanding their money back immediately. But Burry trusted his rigorous risk assessment so much that he actually restricted withdrawals and isolated himself to protect the trade. He was totally willing to be hated as long as his math was right.
Section 4. Burry's recent market moves, 2024 and 2025 trades.
Let's move to and see how this builds into his recent activity. Notice the 100% sell orders completely blanketing his early 2024 moves. Burry aggressively liquidated his positions in American tech giants. We are talking completely dumping Amazon, Alphabet, and Oracle, which had made up about 15% of his portfolio just a year prior. Why do that? Because his deep value radar was flashing bright red. He looked at the valuations, saw the massive A-hype, and flat out stated the environment was eerily reminiscent of the dot-com bubble back in 2000. Now, what's really interesting about this slide is how clearly it maps out his contrarian shift. While he was dumping high PE U.S. tech, like Oracle, which was trading at 37 times earnings, he was simultaneously pivoting hard into what everyone else hated, Chinese tech. He bought heavily into Alibaba, JD.com, and Baidu simply because they were trading at multi-year lows and offered that crucial margin of safety. Alongside that, he poured about 7% of his portfolio into the Sprott Physical Gold Trust. It's a classic inflation and economic hedge. He was literally selling the American tech bubble to buy international value and physical safe havens.
And at the exact same time, notice how corporate insider buying dropped to its lowest level in at least a decade. The very executives and directors running these publicly traded corporations were selling off their own stock at the fastest rate in over 10 years. When the people inside the machine start heading for the exits, a contrarian like Burry takes it as major validation that a top is near.
Which leads us to the really explosive finale of Scion Asset Management. In late 2025, Burry took direct aim at the absolute darlings of the artificial intelligence boom. He bought massive put options, which is essentially betting on the stock price to fall, against NVIDIA and Palantir. For Palantir alone, he held 50,000 contracts. He compared the AI hyperscaling of capital expenditures to the doomed telecom overbuild of the dot-com era, where fiber utilization eventually collapsed down to just 5%. And then, on November 10, 2025, he voluntarily deregistered his firm with the SEC, liquidated most of his positions, and returned the remaining $155 million to his investors. He effectively shut down external operations entirely.
Section 5. Lessons for Everyday Investors. Apply Burry's methods.
So the crucial point is this. You don't actually need to trade complex credit default swaps to learn from his strategy. First, always demand a margin of safety. Don't overpay for the hype. Second, think independently. Just because everyone is buying AI stocks today or real estate in 2005, it doesn't mean it's structurally sound. Third, diversify into uncorrelated assets, kind of like his move into gold or international equities. And finally, focus on the true underlying intrinsic value of a business and completely ignore short-term price fluctuations. Lost capital is way harder to recover than gains are to achieve.
Which leaves us with one final lingering question. By deregistering Scion Asset Management in November 2025 and basically walking away from institutional money, is Michael Burry quietly signaling the top of a catastrophic AI bubble that's about to burst? Or, as some of his critics suggest, is the ultimate contrarian simply stepping away from a modern market narrative that he fundamentally no longer understands? Let that sink in as you look at your own portfolios. Thanks for joining us for this explainer, and we'll catch you next time.